Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome to this Peak Prosperity Podcast. I am your host, Chris Martenson, and quantitative easing, it's progressing apace with recent job market weakness leading to speculation that perhaps the so-called tapering won't begin now until March of 2014. Of course, the equity bulls love that idea. And on the political front, the government has kicked the can down the road for a bit longer with a continuing resolution that also allows the president to unilaterally lift the debt ceiling. And with that power, we can be pretty certain that no meaningful political dogfights over the debt ceiling will ever happen again. The president will simply lift the ceiling and off we go. So how are QE and debt limits related? Both have at their core the idea that we cannot tolerate limits, neither monetarily nor fiscally. Both the Fed and DC are now solidly centered on the practices of always promising and delivering more. But can they? To help us make sense of this today, we have the pleasure of speaking with John Rubino, publisher of DollarCollapse.com, a popular online hub for news impacting the economy. John is the author of several well-received books foretelling years in advance the collapse of the housing market, the decline of the U.S. dollar. Here he's got another book on the way. Looking forward to that. Before starting his website, John was a featured columnist with TheStreet.com, Individual Investor, and a number of other influential financial publications. His perspective on Wall Street and the currency markets is shaped by his past roles as a Eurodollar trader, equity analyst, and junk bond analyst in the late 1980s. So that sets him apart from anybody at the Fed with zero trading experience. John, welcome.
Hey, Chris. Great to be back.
Excellent. So you recently wrote a piece. Here's where I want to start. Really interesting piece entitled, Welcome to the Third World, Part 10. Suddenly Being a Politician is Hard. Let's start there. What's the central thesis of that piece?
All right, the central thesis, the overarching thesis of that series, because that's the 10th in the series, is that once you borrow more money than you can ever hope to pay back, the system becomes ungovernable. You can't do the things you used to be able to do, which is to basically buy votes with new money because you're out of money. And that's what's happening to the U.S. right now. So we have a whole generation of politicians who have never had to stiff a major constituency. They've always been able to find the money to keep the people who put them in office happy. But suddenly, with these debt ceiling things and QE, maybe being scaled back, et cetera, the amount of money that's available is no longer sufficient to keep everybody happy. It used to be that the Democrats and the Republicans would basically cut deals in which the Republicans got an expanded global military empire, and the Democrats got an expanded entitlement state. And they were both more or less happy. But now there's not enough money for both of those objectives to be satisfied. But now they're at the point where the money isn't sufficient to satisfy both of those objectives, and so somebody has to lose. And these politicians have never had to do this in their careers. They've never had to stand before an audience and tell hard truths. And they don't have those skills. The system hasn't been selecting for blunt honesty in the political system right now. And so you've got John Boehner and Nancy Pelosi, who have never had to do this before, and yet they have to find a way to do it, or they have to convince the Federal Reserve to continue to print new money to the horizon and just get the political system to raise the debt limit or just suspend the debt limit, and then just cut loose. At that point, there isn't even any pretense of fiscal sanity in the system. And I think we're heading to that point right now, because the alternative is to tell the truth, make constituencies mad, and risk the stock market tanking and all the things that started to happen when Ben Bernanke intimated that QE might at some obscure time in the future be scaled back by 5 or 10%, and the stock market started to collapse. So we're reaching the point where we basically just give up in the political system and say, look, we can't stop spending from growing. We can't stop the deficits from expanding, so we're just going to have to finance it. We're going to have to put the pressure on the dollar in this system as the safety valve. So we're going to depreciate the currency, and we're just going to let it run from there. And at that point, everything changes. Because right now, the people don't really know policy is going to be, because you've got all these cross currents. But once they give it up, once they completely suspend the debt limit, and don't even attempt to scale back the entitlement state and the global military empire, and it becomes clear to everybody that that's policy going forward forever, then I think things get really interesting. And we can talk about what specific markets would be most hurt and most benefited by this if we have time. But I think it becomes a really fascinating market with some analogs in the past that are both interesting and scary, like Weimar Germany and Zimbabwe and places like that.
Well, you covered a lot of excellent territory there, and the part I really want to focus on first is this idea that managing for expansion is a very different skill set for managing for, let's call it stasis. The pie is no longer expanding. It's just sort of hovering in place, which is certainly true no matter how we measure it. Even if we take the GDP, which I think is overstated badly, it's still showing basically stall speed. And there's not really enough left to go around. And the context for this that's really important to me is to understand that if you take, and I've done this, I just did this yesterday, so I have the numbers very fresh, total credit market debt, which is everything, right? That's state, federal, household, corporate, and everything private and public you can imagine. That's real debt, not liabilities, just debt. And you look at the time series of that from 1980 to current, the average across all 30 years there is 8% compounded annually. And so that's the world that the Fed knows, and that's the world that DC knows, which is a world where you can constantly expand debts faster than underlying GDP growth, which was a fraction of that. It was about half that. So this idea that you can constantly expand debts faster than income is something that we've lived for so long. In your thesis, we've raised an entire generation, I'm putting air quotes up now, of leaders who don't actually have any context for understanding the alternative world, which is you can't do that, right? So in the alternative parallel world, you have to live within your means, and you're saying that we've got basically no muscle memory, no institutional memory, no mentoring. Who would they, like there's just not, they don't have the skills here.
Yeah, to run a government with a fiat currency during a credit bubble is one of the nicest jobs in the world, because you can find the money to make everybody happy. And so basically your job is to look generous. You create bills and you work them through the legislative system that gives stuff to people. And so everybody's happy, and you have incredible status in society, and everybody loves you. And that's the way it's been for the last 30, 40 years for U.S. politicians. They have had no real limits, no need to prioritize, no necessity to sit down with people and say, look, you can't have this. You know, they just didn't have to do that. And so they had the easiest job in the world without realizing it. And I think they're just not realizing how hard politics actually is in normal times, in times, as you said, of limited resources that have to be allocated through the political process. That's not something they've ever had to deal with. And so I think they're not happy anymore. And I think we'll probably see a wave of retirements of these old-style, log-rolling, back-scratching career politicians, because suddenly their career isn't fun anymore. And so who comes along to replace them remains to be seen. And it'll probably be, you know, Chris Christie types in general, and Tea Party types also, although in more rare cases, I think, because that's more specific taste for a congressional district. But I think we'll see people come in who at least give lip service to telling hard truths. But the process, as it goes on, we'll have a mix of people who still don't want to tell the hard truths, like today, the guys who dominate Congress and the Senate today. And then people who come in and want to draw red lines and just not vote for things that raise the debt limit or unbalanced budgets or whatever. And so you get the kind of gridlock that we saw in the last few weeks, where a small group of people just don't want to raise the debt limit. And they'll make up excuses like Obamacare or whatever to avoid having to sign off on something that they find abhorrent. And within the Republican Party, I think there will be a kind of civil war. I think it's already started between ideologically driven people who are elected with Tea Party support, who are like Ron Paul. They just don't believe in unbalanced budgets. They don't believe the government should be able to declare war, or the president should be able to invade other countries without congressional backing. And they just aren't going to vote for these things. And if the government shuts down because of it, that's the government's fault. That's not irresponsibility on their part. They just don't believe these things are right, and they want to stop them immediately. So you get, within the Republican Party, this battle between the majority, who are basically career politicians who want to cut deals and keep their nice jobs, and people who don't care about any of that. And so either the Republican Party collapses into a civil war in which you have these really hard-fought primary campaigns that hobble whoever wins for the general election, and the Democrats are the majority party for a decade, or you have the libertarian branch of the Republican Party splitting off and becoming a third party that actually gets 10 or 15% of the vote in elections, which will also guarantee that the Democrats get to be the majority party for the foreseeable future. And if that happens, then basically the government is cut loose. There are no limits on what we're going to spend going forward, and there is absolutely no limit on the amount of money that will be created to finance it. So that to me looks like the end stage of this process, when the final political barriers to just letting it all hang out financially are taken away, and then we just really go for it. We become the Roman Empire in 300 AD, or Weimar Germany, or whatever, and that seems to me to be just a couple of elections away. The next presidential election is when it could start.
Well, there's a lot of competing ideas in there. I think the central thesis of it all for me is this idea that something has really shifted in this story. It could just be, if we constrain ourselves to the economic side of the story, it could just be the Japanese story, which is once you pass a certain level of debt and indebtedness, that there's really no amount of monetary policy that can really fix that. Bernanke, swooped into office a long time ago, claiming that he could avoid Japan. We haven't avoided Japan. We're exactly Japan at this point in time: low growth, stubbornly high unemployment, and monetary policy that seems stuck at a 0 pound on the interest rate level with no traction, and exploding government deficits. I think that about encapsulates the Japanese experience. So we're recreating it. And, we wander over to the energy side of the story. We see oil safely over or around $100 a barrel on the world stage for a couple of years now, and that's a new fly in the ointment. And my thesis is that there's nobody in the Fed who really truly understands where we are in this story right now. They're trying some really old story stuff. And by the way, it fits into the political story. And I normally steer very wide of politics, partisan almost entirely, but politics usually, because it's usually not that helpful to know where we're going, but I think it is here, because if you have leaders who don't understand the dimensions of the predicament we're in, and they don't quite have the muscle memory or the institutional experience to know what to do next, and then we combine that with this sense that our monetary masters are also going to try some things that are going to be politically expedient, right? Everybody who's currently in power and has their hands on the levers of power loves quantitative easing, because they're getting rich like crazy. You look at all the data right now on CEO pay, or who's really taking it home in the 0.1%, and who's really not taking it home. There's a very, very large, very profound story here that has sociological implications, political implications, has all kinds of implications. The one dialogue I didn't see happen even once, even on the budget side, even from the most diehard smallest splinter faction of the GOP, I didn't see anybody really talk about this idea that we're going to have to start fundamentally living within some very real limits, that something has really changed in this story. And the chief critique I have is really, we've been doing quantitative easing for 6 years now? Can't we at least hold up a placard and say it's, unless you count the rich getting richer, it's not really working, and there's something else at play here, and that's the dialogue I don't see happening. So it feels to me like politics is gridlocked, kind of stuck in its competing ideologies, which sort of guarantees some institutional sclerosis on that front. The Fed is still sort of groping around, trying stuff, and basically committing to flying by the seat of their pants. As the data suggests, they'll tell us how much more they're going to print or less. But really, there hasn't been that fundamental backing up of saying, whoa, what happens if we get all this wrong? What happens if the Fed is not successful in engineering an economic liftoff? What happens next? And I'll tell you, from my standpoint, and I'd love to get your views on this, John, when you look at the equity markets worldwide, I mean, look what's the Greek stock market's up, even though they're utterly collapsing economically and politically. Their German DAX has hit an all-time new high. S&P is at an all-time new high right now. We look at all of that. Are those good things, or is this, or do you smell a bubble again?
Well, we're back in a lot of ways to 2006, where the stock market is hitting records. You know, the last time the stock market was at this level was right before the crash in the housing market that sent stocks down by 50%. And the time before that it was at this level was 1999, early 2000, when the tech stock bubble was in full swing and about to pop. So stocks hitting these levels is actually a very scary indicator, because the last two times they've been here, it's preceded a massive world-shaking crash. And just about every other indicator of financial trouble, specifically debt levels around the world, are also back up there. So it wouldn't be at all a surprise to see a really serious turn in the tone of all the financial markets in the near future, just because whenever they get here, they seem to do that. So that wouldn't be a big surprise. On the other hand, it is true that in past periods of extreme monetary ease, you see the real economy kind of tanking, but you see the financial markets continuing to look healthy in nominal terms. You know, the stock market in Zimbabwe went through the roof when they were hyperinflating. And like you said, Greece is collapsing, yet their stock market is way up. So it's possible that if we really let fly monetarily and fiscally here pretty soon, that it'll be reflected in the equity markets continuing to go up beyond levels that we think is reasonable by any kind of rational analysis. But they'll do that because the money has to go somewhere. And it's not going to go into the real economy, because the real economy is moribund, but the financial markets are liquid and easy to invest in, and you got this money, and where can you put it? You put it in treasuries and you put it in stocks, and they continue to go up for a while. That could happen, but it's not a sign of health. And by the way, you mentioned earlier that monetary policy cannot fix excessive debt, and that is absolutely right. And we're finding that out with QE to infinity not really working, with the economy slowing down. But it's also true that fiscal policy can't fix this either, because the fiscal policy fix of scaling back spending and trying to live within your means gives you Greek-style austerity. So we're at the point where we don't have a painless option. We only have a choice of what are looking like now catastrophes. You know, we have very serious pain coming. And the question is, how are we going to engineer it? You know, what emphasis are we going to place on what part of the financial system to try to get out of it and then fail, and what will be the outcome? But if we try to force the dollar down in value, then we'll have a currency crisis. If we try to scale back our spending and live within our means, we'll have a flat-out 1930s-style economic crisis where people start going bankrupt, unemployment spikes even beyond where it is now, and we start looking at a deflationary depression. And that's it. We borrowed so much money that we really don't have any other choice. And so the history of the last 10 years, and probably the next few, is us coming to grips with this and deciding what kind of poison we're going to take going forward. And I think we're definitely leaning towards monetary ease. And whether that works or not, we'll see. But it's definitely the policy option that we seem to have chosen.
I think you've got it exactly right. I like that framing, which is, listen, you can't austerity your way out of a hole this deep. So then what do? Well, you can try and print your way out. That doesn't really work. Really, there is a third option, which you and I might assign a fairly narrow possibility of happening, but that's to grow your way out of it. Of course, you know, I think that's what the Fed in its heart of hearts was really, you know, double fingers crossed, hoping for, and obviously politicians are hoping for it, which is a rapid resumption of economic growth. And that was, of course, the whole story behind the Greek rescue packages. When I was looking at those in 2008, 9, 10, you know, when all that was being developed, they were, by now Greece was supposed to be back at 6% GDP growth. And of course, they've kind of inverted that number, put a negative sign in front of it, and that's where they happen to be instead. And so growth is really always the bugaboo that's sitting there. As long as we get growth, we can get our way out from under this. And that's what I guess I'm queuing in on here, is the point that it's not here. And in order to think that we're going to double GDP growth going forward, you have to, I don't understand the basis of that story. What is the story? Where does it come from? Is there a new technological revolution we don't understand? Or is there, where's the organic growth for that? Because in times past, when you've had come out of a recessionary period, you've had a couple of things going for you. You've had a massive deleveraging happening, so people had walked all of their debts down, particularly at the household level, so they're ready to re-leverage. Bernanke's certainly primed to the pump. We could re-leverage in a skinny minute if banks had people they wanted to lend to, right? They've got excess reserves just coming out their ears at this point in time. But the lending isn't happening because the willing borrowers aren't there and also the willing lenders aren't there. So there is that sort of stalemate happening. The fuel for this growth has just been piled up like so high. It's so obscenely high. It's like they built a 20-story funeral pyre for a gerbil, and so now, if there are no pain-less options left, how do you see this playing out? Which pain are we going to choose here, and what does that unfold like?
Well, on your growth idea, Chris, the traditional Keynesian tools for generating growth have been cutting interest rates and running deficits. And that puts money into the hands of people who then spend it, and then the businesses that are getting this new money coming in, hire people, et cetera, et cetera. And the idea is that generates growth and tax revenues, and you go back to being healthy. But after a certain point, when you owe so much money that people can't borrow anymore, as you said, banks have these reserves that are just sitting there that they can't figure out what to do with because households are already heavily indebted. Now, we've replaced credit card debt with student loan debt, basically, and haven't improved otherwise. So we owe a ton of money. We don't want to borrow more money as individuals mostly. And banks don't see any really attractive borrowers coming through the door. So the system doesn't work with these old tools anymore. So if you wanted to try to generate growth and have an actual chance of doing it, you'd have to attack the structural problems in the system. We'd have to lower the barriers to risk-taking and capital formation and stuff like that. But that's ideologically unpalatable to the people who are running the show now, because that means immediately putting money into the hands of the 1% who already have plenty of money. And so that's not going to fly. And so we probably, even though we're trying for growth right now, that's the idea, we're not going to generate it. As you said, the economy's not growing, even after 5 years of absolutely insane money creation and the lowest rates that we've ever seen for loans. And part of that, by the way, is that as we're giving money to borrowers with lower interest rates, we're sucking money out of the accounts of savers. So everybody who lives on a fixed income is being crushed by this policy, and that kind of offsets the benefits of slightly cheaper mortgage rates and stuff like that. So I don't think with the tools that we have on hand we can generate growth, and that's being borne out by the last few years of no growth. So at some point we're just going to double down, because that's all that's left. These guys only understand what they've seen work in the past, and what they've seen work in the past is aggressive monetary policy, big government deficits, lots of spending on the social side of the economy that puts money directly into the hands of consumers. And so we'll do that again. I mean, if the economy starts to slow down from here and drift into a recession, which it easily could based on the momentum of a lot of indicators, and especially if we have a stock market correction right now, which we should, just for technical reasons, even leaving everything else aside, then we would see the government respond as it always has, with even more monetary ease and even bigger deficits, and we just get more of the same. So I don't see a way out of this. I think there are going to be lots of theories tossed around, but none of the ones that have any chance of working will be politically palatable. So we'll rely on the stuff that we've done in the past that we thought worked back then, and so we'll just do more of the same, and we will get more of the same. And at some point, the system spins out of control. So it becomes a matter of timing. Does it happen this year, next year, 5 years from now? That's the thing that's hard to call.
Well, John, I was listening to Jim Rickards recently and at the Casey Summit, and he was saying that he had this whole list of things that he had written in a book a couple years back that the Fed was going to try, and basically 14 things on the list. 13 had check marks next to them, and number 14 on the list is giving everybody an actual tax cut, a big one, like some kind of check back or something like that. So you run a giant fiscal deficit on the basis of that, with the Fed, hand shake and a wink, saying, "Don't worry about it. We'll monetize whatever that pain is right there." And it would have to be fairly meaningful, some big giant number, hundreds and hundreds of billions of tax credits flowing back into people's pockets. So that would be a bypass mechanism. Do you think that's a possibility in your view?
Well, that's a variation of the debt jubilee idea, where we just print a lot of money, give it to people to pay off their debts, and then with the idea that restarts the system. People don't owe as much, so they can borrow more, and then normal life can return. And I think that would give us a burst of consumer spending, but I don't think it would translate into anything because the government will have had to borrow that money. So that's functionally the same as the government borrowing more money and creating more currency out of thin air and then spending it on stuff. And we've been doing that. So in effect, we run an extra $500 billion a year deficit. And something has to give somewhere if that's what we do. Maybe the dollar gets weaker because of that, or maybe the bond market starts to behave badly, or whatever. Or we create asset bubbles where energy prices spike and houses go up to the point that they're not affordable for regular people anymore. We can't do this expecting a free lunch. For every action in the world of money and fiscal policy, there's some kind of a reaction. And so the question with a policy like that is, what other part of the economy will it distort, and will that distortion be enough to offset the benefits of people having extra money in their pocket? And my guess is that it will be, because it has tended to be in the past, and that we're reaching the point where we can't control these distortions anymore because the numbers are just too big. So we'll definitely try something like that. That's one of the things that the government will go for, especially during an election year if a recession is looming. But my sense is that it won't work any better than the other stuff that they've tried, just because the big looming problem, too much debt at government and individual and business levels throughout the society, is not going to be fixed by this. It's just going to be shuffling debt from one account, the individual's account, to the government's account. And that doesn't solve any of our problems.
Well, here we are all the way out and deep into 2013. I've been very, very cautious and preaching caution for a long time on the markets. And because this does smell to me exactly like 2006-07, also 1999. And it's very, very easy to be early in calling a bubble. It's very hard to sort of persist through it. And I'm sure that of the few financial managers out there who are being very prudent and understanding the risks, I'm sure they're experiencing all kinds of career risk and pain at this point in time because they're trying to do right by their clients. And I'm sure people just want in on this. That's one of the natures of a bubble. And you always know you're getting to the end stage of a bubble when you suck in the last few people. Because, of course, it takes more and more fuel to keep the rocket sort of perched at that height. I mean, think about somebody who suddenly wants to get into Google. Well, that's going to cost you at least $1,000 a share today, right? So that's big money. And so the higher things go, the more money it takes to lure in those new entrants. But really, I think that's one of the defining features of a bubble is when they've got the last person on board, pretty much, who's going to get on board. How have you been managing talking about markets to people who are looking for your perspective on these things? And are you telling people to stay in, stay out, or what would you advise at this point in time?
When someone asks me what I think is going to happen in the next year, I just say, you know what, I was wrong for the last 2 years. I thought this thing was going to end in 2010, give or take, and that we just couldn't keep going and doing what we're doing. And so my credibility for short-term predictions is basically zero right now. But having said that, all the imbalances that we're building up over the last 30 years are bigger now. And so if debt was the problem in 2008 and stock valuations were the problem in 2000, we've got both of those back. We've got all the technical and structural and fundamental reasons for hard times in the near future. And so we should probably be preparing for that. However, since this has gone on for at least 2 years longer than I thought it would, there's no reason why it can't go on for a few more years. So we just can't know about the timing. This thing does not have to revert to reality in 2014 necessarily, because a printing press is just a phenomenal tool for fooling people, and we have the biggest, best printing press that's ever existed. But the turn is coming, and when it comes, it's going to be really dramatic. When people finally figure out that this is really a charade, and none of it is based on reality, and the actual reality under the surface is really horrendously bad, then we'll see a mass change in crowd psychology in the markets. And everything that seems fine right now will disappear, and the general consensus will be that we've lost control, and things are spinning out of control, and we better protect ourselves. And so that day is coming. It's just a question of when.
Yeah, well, so I've been wrong for a while as well. Here was my organizing framework. First of all, I noted that bubbles usually are separated by about a generation because the pain of the prior bubble takes a little while to wear off, and typically everybody who lost money in the first bubble has to die so people can completely forget what happened and go through it again. It's astonishing to me that we've been through not one, not two, but we're in our third bubble now within a 15-year span, and that's just astonishing historically. And so it really speaks to a couple of things. One is sort of the power of the printing press. I think there are other tools at their disposal, not the least of which is a very, very compliant press, and can I call it a propaganda machine? Because it's really the shaping of opinions is really quite elegant. Actually, golf claps. I mean, I'm really impressed with how well opinions are managed. I believe the stock market is largely a signaling mechanism. It's one of the reasons I think it remains so elevated. It's too important to let it go down. And so really, as you mentioned, though, it's the word illusion is the capturing phrase there for me, because this is all illusory. We've got the best stage managed recovery that money can buy, but when you peel back the covers and you really look at what's going on, in truth, what's made this country, the United States, an economic powerhouse in most of Europe and Japan was actually having a solid middle class, and every single statistic speaks to a hollowing out of that class. And so the larger narrative I have running now is one of this is kind of a dark one, but it's the parasite doesn't know how much it can take from the host. And so Wall Street's used to its cuts, which is a very, very large proportion. The financial companies as a percentage of overall profits are very, very high, and they feel entitled to those cuts. And the problem is when the pie is no longer expanding, those cuts suddenly become larger and larger and larger proportionally, and it leaves less and less and less to go back. And it's not that different from what happens when you start drilling for more and more and more expensive energy. There's just less surplus, less left available to go floating back into the rest of society. So if we wander over to the rest of society, look at what's going on. When you look at food stamp usage, you look at real median wages, you look at things that indicate whether economic health or stress within the middle class, it's pretty profound that this has been actually one of the most startling 10-year periods of reformation in the overall balance of the society. It's been absolutely startling. The mysterious part to tie it all the way back to the political side is I'm just astonished that nobody is capitalizing on that politically. It seems easy. It seems populist. It seems like there should be just a groundswell there. Like you mentioned, maybe a libertarian or some other party could come along and just simply articulate the plight of the masses in a meaningful way. They'd make just massive amounts of hay. Why aren't they doing that? Well,
part of the problem is that the policies that are causing this are sold as being aimed at helping the people who would populate that kind of a party. In other words, big social programs and easy money and low interest rates. These are all designed to help working people get jobs on the surface. That's how they're sold. So it looks like the government is actually out there trying to help you. If you're somebody working at a $10 an hour job and desperately trying to support a family, the guys in charge right now are the ones who are speaking your language. So the fact that under the surface there's a lot of data that points to them not actually helping you, them actually funneling tons of money to the richest 1% banks, that's not as clear as the idea that, hey, we're expanding this new program that gives your kid daycare, and we're giving you more money for food stamps, and we're fighting those Republicans for good jobs here in the United States. And so you're voting for the people who you think are going to help you because they're saying that they are, but the policies that they're actually pursuing are actually kind of a globalist set of policies where they encourage companies to move jobs overseas and hollow out the factory jobs we used to have here and replace them with part-time jobs. You know, if you look at the details of the job statistics that are coming out lately, it looks like more people are working, but more people are working in part-time jobs. The number of full-time jobs has not gone up in the last 5 years in the United States. So the decrease in unemployment is pretty much completely due to people getting jobs for 29 hours a week for $11 an hour and being counted as employed. But you can't live on that kind of money. So we're creating this whole generation of people who are even more dependent on the government than the most dependent people were 10 or 15 years ago. And there's really no solution in the short run for this because technology is changing in a way that makes it harder for good full-time jobs for, say, a high school graduate to come back, because we've got a revolution going on in robotics right now that is going to replace Chinese workers in China with roboticized factories in the United States that don't really need many people, but bring the production back here. So the manufacturing side of the economy is going to come back, but manufacturing employment is not. So it's really not clear what the solution is, and it's not clear how you get there politically, because what policies do you put into place once you start battling the 1%? You know, do you raise taxes at the high end dramatically, like in France? And would that work? Probably not. Do you cut government spending to bring deficits down? That's instant austerity. That's not good for working people. Do you scale back the global military empire? That probably would be relatively good, but it would also give us 5 million unemployed soldiers in the next few years if we closed all our military bases and brought them home, and then a whole bunch of defense contractors laying on people. So it wouldn't help the working class very much either. So it's really not clear how you translate disgust at what's happening into a political movement right now.
You know, it's interesting that when I talk to younger people, so under the age of 30, but particularly under the age of 25, they've sussed all this out, and many of them have pretty well opted out of the whole system. They've looked at it and said, listen, I understand that the bargain you're trying to sell to me up there, you boomers, is just help us maintain the status quo. It's in everybody's interest. But younger people have said, I don't see my compelling interest in that story. And so truthfully, younger people really have nothing to gain by preserving the status quo. They have everything to gain by busting it open and trying something new, some sort of jubilee, writ large across, things besides economics, some reset button. Is there what I'm getting from what you're saying is there's no way we're going to tweak our way out of this with current policies, current leaders, current thinking. There's really no easy way to sort of vote this, tweak that, drop this, lift that to get ourselves back into shape, but that there is some reset event that's going to be required.
Yes, and it can't happen through the political system because the people that are in charge now are so entrenched. I mean, the baby boomers we still run things. Mm-hmm. We're running it for our own self-interest,
of course,
as we always have. And so that a few million college kids go to Ron Paul speeches and chant "End the Fed" and stuff like that is very hopeful for the future, but not for the immediate future. They can't affect things decisively in Washington right now because the guys in charge are just too big and too powerful and too able to co-opt enough of them to stop any kind of a movement from becoming decisive. So there will be a reset, but it'll be driven by the market. Some aspect of our financial system is going to fail at some point. My guess is that it's the dollar, because that's what we're targeting. We're fighting a currency war, and we're trying to force down the value of the dollar to gain all the benefits from a cheap currency at the expense of our trading partners. And we don't seem to realize that so many dollar-denominated assets are owned by the rest of the world that if they decide that that's our policy going forward, why would they hold treasury bonds? And why wouldn't they just dump them on the market? It would cause them some short-term pain, but it would protect their investment. And I think that China and Russia and Brazil and India are all looking for ways to do this as non-disruptively as possible. And so it's very possible that we see the dollar just being bypassed in global trade to a greater and greater extent in the near future, which means fewer dollars are needed in the central bank reserves of other countries, which means a lot of selling pressure on treasuries and a lot of pressure on the dollar in general. And that could be the thing that causes us to stop in our tracks and have to reevaluate our policies and have to reset the system. But it won't happen painlessly. I mean, a big drop in the value of the dollar would cause all kinds of disruption in all kinds of domestic markets and give us, a decade of really chaotic pain that we have to figure out a way to get through. But that's when the political argument gets interesting, because that's when it is meaningful. There's actually the possibility of setting up new structures and maybe going back to the original idea of sound money and individual freedom and a constitutionally limited government. That would be my choice of outcomes here. And but there are a lot of other choices. The Big Brother 1984 dystopia is probably more likely than a return to Jeffersonian constitutionally limited government. But at that point, at least there will be a chance of winning that argument. And so in that sense, the world will be a horrendous place for a while, but it'll be interesting from a political standpoint because there will be the possibility of actually winning and setting up something that's sustainable.
And so this idea then is of the reset is that we're making claims against stuff, and those claims are in the forms of dollars. They're in the forms of debt, which is denominated in dollars. It's derivatives. It's all the claims. It's all the paper articulations. We're just increasing those like crazy. The stuff is not increasing nearly as crazily or as quickly, and so there has to be a rebalancing that has to happen at some point. And guess what? Stuff doesn't actually rebalance. It's always the currency. That story's been written so many times historically, and it always comes with one of the most extraordinary wealth transfers. And so I think we're talking about different phases of this. I submit we're already in phase one of it. Phase one, we already had a stealth transfer. You can already see it showing up in the top 0.1% take-home pay. The transfer has been from savers to debtors, but primarily it's been from savers to the banking system, if you want to be really clear about where I think the bulk of it went. That's part one. And then part two is when the currency itself or the claims against real stuff has to be reset against the amount of real stuff that exactly exists out there. Painful process, very turbulent. When the dust settles, it could be months, could be years. You find out that pretty much everybody is impoverished to some extent, but not everybody, because guess what? The real stuff didn't go anywhere. And so there will be a relatively few holders of that at the end, if history's any guide. And so that's really what's being obscured, I think, in all of the dialogue and diatribes that I'm hearing and reading about at these points, because nobody really wants to talk about the fact that we are in a zero-sum game. There's winners and losers. That's what happens when you hit that sort of top of the rocket launch and it doesn't have fuel to go any further, and then it comes back down again. There's just a massive, massive transfer of wealth that happens. It's already happening. And unfortunately, it's happening from savers and old people on fixed incomes, to some fairly already well-off folks. And then what you're talking about is some final moment that comes along, who knows when, unpredictable, chaotic systems, depends on a lot of variables, none of which are remotely predictable. And then there'll be a fairly robust wealth transfer, and your prediction is it's going to happen quickly. Why is that?
Well, in Austrian economics, they call that the Kraken boom. That's the point when a tipping point occurs, when a critical mass of people figure out that inflation, the depreciation of the currency that they have in their pockets and their bank accounts, is government policy, and that it's not going to end anytime soon. So they lose faith in the currency, and they all bail at the same time. They bail by buying real stuff for currency at basically any price. They just want to get rid of the dollars or the euros or the yen that they own. And so that causes the price of things to go through the roof. But it's not an inflation in the sense of a sudden increase in the supply of currency. It's a collapse of trust in the currency. So nobody wants to hold it anymore. So the same supply of currency, even if the value or the supply of dollars stops going up, the dollar still tanks because nobody wants to hold it anymore. And that happens very, very quickly. In a famous quote from Ludwig von Mises. He says it happened in a period of days or weeks, and that's the way it was in Weimar Germany. You had a fairly normal currency, and then 3 or 4 years later, it's gone. It just vaporized and ceased to function, and most of the vaporization happened in the last couple of months. So that's the really scary possibility out there, where things are going along and they're not great, but they're not bad, and they're okay, and then one day it all just changes. Everybody just figures it out, or enough people figure it out, and then they sell or they dump their dollars in return for real stuff, and then the system just stops functioning. So that's the end game here, and they've been able to keep this going a lot longer than seemed reasonable, and they've been able to build up imbalances that just didn't look possible. Chris, if you and I talked about today's numbers 10 years ago, I think we both would have agreed that that's crazy. This can't happen, and but it's happened. So the fact that it's happened means that it could go on for longer than we expect, just because these guys seem to have the ability to fool us in a really profound way, using a lot of different tools, and to keep us in the dark longer than we should be in the dark. And so maybe they keep it for a little while longer, but at some point, the imbalances get so big that something blows up. And my guess is that it's an Austrian-style crack-up movement, that the dollar is the focal point.
Well, John, you're absolutely right. 10 years ago, you could have not have dropped me into this seat and convinced me that we are where we are. But here we are. And I'm ambivalent about all of this, because on the one hand, I actually have enjoyed this extra respite in time, because I've been getting myself prepared in a variety of ways, physically, emotionally, financially, just getting ready for, I think the crack-up part's going to be relatively disruptive, if not painful, for a lot of people. And so I want myself to be as well prepared as I can be. And Ron Paul recently said, I saw an interview with him just a couple days ago, where he said, the longer QE goes on, the worse it's going to be when we try and get out of it. And so that idea of storing up this potential energy is what you're talking about as well, and something I ascribe to, is this idea that the longer this goes on, the more fuel we've sort of put into this situation. But then people suddenly turn, and they will for some unknowable reason. It's like that silent dog whistle that gets blown that only dogs and investors can hear, and bang, they're out. And off they go, and it's a very, very rapid, very chaotic event. Of course, we're computerized today, so things can possibly go a little faster than they ever have before. And so that leads me all the way back to my motto, which is I'd rather be a year early than a day late, but I guess I have to amend that. I guess I'd rather be 2 or 3 years early than a day late, because I've been a little early on this one as well. But all the signs are there, and for people who are paying attention, boy, it's deja vu all over again. So here we are. And do you have any interest in talking about your upcoming book, which I hope is going to deal with this and help people navigate this crack-up period?
Yeah, this is going to be another one co-written with James Turk of Gold Money. And we did a book called The Coming Collapse of the Dollar 10 years ago now. Mm-hmm. And a lot of the predictions in that book turned out to be true, because we said short the big banks and go long gold. And for the next... after a couple of years of being too early, then it all worked out, except for the collapse of the dollar part. The title of the book turned out to be a prediction that didn't turn out to be true. Mm-hmm. So much has happened in the last 10 years that we're doing a similar book that brings everything up to date and makes a lot of the same predictions, because we basically reset the clock in the last 5 or 6 years to where now it's a great time to go long precious metals again. It's probably a good time to be shorting the big banks. And so we set the stage for that with a story of the past 5 or 6 years and the rationale for basically betting against the system. And if we get this thing written and published the way we hope to, we'll have it out before Christmas. So it'll be a Christmas present for people who have friends and relatives who really want to understand this stuff.
Well, fantastic. I'm really looking forward to it. Dollar Collapse was a great book, and James Turk is somebody I admire tremendously, as I do you. So we've been talking with John Rubino. You can find more about him at dollarcollapse.com. Of course, this upcoming book, look out for that as well. And I'd love to have you on when that book comes out so we can talk about that too. John, thank you so much for your time today.
Great. Thanks, Chris. Enjoyed it.